Ones I think I would highlight is firstly on infrastructure, where clearly there's been a big push on the capex spend, and I think we were particularly interested to hear about the proposal for a new development finance institution. That is a exciting idea that really provides a mechanism for India to raise more finance for its national infrastructure pipeline. And I think we certainly see opportunity in partnering with India on that. I think secondly, we were pleased to see a variety of reform measures for the financial services sector, where clearly that is one of the most vulnerable sectors in the economy at the moment. We were obviously delighted to see that the FDI limit on insurance has been raised up to 75%, which has certainly been a long-standing request of the UK. And I think we think that's a really positive move to help open up India's insurance market. I mentioned Gift City, where we recently agreed a new strategic partnership on Gift City, and I think we were pleased to see the measures on tax and on fintech in terms of encouraging business into Gift City. And I'd note that another UK bank, HSBC, just opened their branch there last week, which is fantastic. Thirdly, within financial services, I'd also point to the announcements on disinvestment, which clearly ambitious targets have been set before, but I think people feel cautiously optimistic that there might be more progress on that this time. And actually, the UK Chancellor offered to work with the Indian side on sharing experiences from the UK experience of privatization, which we went through a lot of in the 80s. So those are some of the areas where I think we are excited to see announcements and where we will be looking to partner with the Indian government. Also on areas, as I mentioned, we've got the COP presidency coming up at the end of this year. And so climate and green finance is a huge focus for us. And while climate wasn't named explicitly in the budget, there were some encouraging proposals on areas such as renewables, solar, and a hydrogen energy mission. So obviously, the trick with all of this is going to be in the implementation. I think one can have a very ambitious budget, and then the question is, is one able to deliver it and see it through? But I think we're hopeful that this was a really encouraging start. It presents a lot of opportunities on the commercial side for UK business and for the UK-India partnership more broadly. And we shall certainly be working very closely with the Indian government on how we can strengthen some of the reform efforts that we saw in the budget. I'll stop there because I know you've got a really exciting and long lineup of speakers to get through. But once again, thank you very much to Deloitte and BBG for convening this meeting. And I'll hand over now to the next speaker, who I think is Mr. Sanjay Kumar.
I have put just these 5 pointers from the economic survey, which I felt defines those debates and the policy pronouncements that were made therein. The economic survey laid a debate on how growth and debt sustainability plays out, or more appropriately, does growth lead to debt sustainability? After dealing with this question, the economic survey did try and establish that the debt sustainability depends on the interest rate and growth rate differential, an old economics conclusion, but important for this year's budget, and we'll come to that subsequently. Connected question to the above was also whether India's sovereign credit rating is appropriate. The overall conclusion was that never before in the history, the sovereign credit rating of the 5th largest economy has been rated to the lowest rung of the investment grade, that is BBB minus or Baa3. The economic survey also stated that India needs increased attention to healthcare. I felt it was a necessity, and the country needs to have more public spending than 1% of GDP. Question of addressing inequality for better economic and social mobility was another important one, and COVID-19 had certainly widened the inequality, and the divide needs to be narrowed down for better growth, and that was also the conclusion of the economic survey. Another important issue discussed through a detailed discussion was improving on innovation to make sure that India moves up on the R&D ranking. It also stated that our companies need to spend more on R&D. This was an aspirational push to emerge as the third largest economy in terms of GDP, current US dollar. There were many other questions, but let me uh, respond to the budget questions and the key pronouncements which came in. Um, in the budget, apart from the fiscal numbers, the government did announce certain policy measures. One of the first on my agenda relates to creation of development finance institution for infrastructure debt financing. Though the government increased the budget size by about 14.5%, but infra spending was budgeted to be higher than the last year by about 34%. So that is certainly a course correction that the government has done. India has a pipeline of about 7,000 infra projects and intends to spend close to about 111 trillion rupees over next 3 years. Uh, Highest spending is slated to be in the next financial year and thereafter. Uh, Setting up DFIs would allow long-term funding and would give boost to growth and create jobs at less skilled and semi-skilled levels. Through DFIs, the government plans to bring in lot more money in the infra financing, and that was the reason why the government brought back the DFIs. DFIs was earlier a concept which was there, and there were two banks, IDBI and ICICI. But later on, I would have liked to see some allocation to the existing capital maintenance, but because as the IMF has said in one of its report, that almost like 33% of the capex expenditure gets wasted over a period of time. So it's very important for the government to have given some more money for the capital maintenance. There was another item which should get covered under the infrastructure development was that urban infrastructure, and the boost came through the more metro lines and the metro lights. That was something different this year. Creation of bad bank, which is on one of the next one on my uh, list, with allocation of about 20,000 crore was a key announcement. And that is also because the banks have a gross NPA of 7.5% as percentage of loans. With bad bank, the asset reconstruction company would be able to leverage at least 5 times and create a right environment to improve the position of the bank. And this is, if I can say, a quarantine center for the NPAs. Uh, Increasing the FDI limit in the insurance sector by 25%, and club with that, if I can add, reducing the withholding tax rate on dividend income for FPIs were another set of changes in the financial sector. I guess Ashutosh will cover more on this FPI withholding tax rate. Uh, Growth in manufacturing was another essential thing because it allows jobs creation. And heartening to note that the FRBM is the Fiscal Responsibility and Budgetary Measures Act that was being argued, but somehow what expected because the government through with fiscal expansion would have definitely you know moved beyond the FRBM limit that it has set itself through the parliamentary you know act. What is notable for me, and we need to thank government for that, despite such a difficult time, it decided not to have any new tax levy or make any upward change in the tax rate to fund the outlay of the budget, which is at about 34.83 trillion rupees, about 500 billion US dollars. Um, and while doing that, the tax collections for funding the budget is going to go down. If I compare with the last year, the personal income tax will be lower by about 3%. Corporate income tax will be lower by 4%. GST by 3%, and excise and customs will stay together, stay at the same level. Uh, while I'm saying this as that from the last year to fund the budget, it has gone down. What is very important to understand that it's not that the overall collections of these taxes have not grown, are not likely to grow. That will definitely grow up because the push of the growth, the economic growth, will bring some more taxes. But what was important is that, as you could see it on the left pie chart, is that the overall tax collections to fund the budget has gone down. Government to fund that, the government has thought of moving the needle beyond disinvestment to privatization, and LIC, IPO, and plans to privatize two PSU banks and a general insurance company, which is in the government sector, were some of the historic decisions announced in the budget, and that may portend a change in the philosophy that the government should be moving out of doing business. The numbers are pretty large, 1,75,000 crores, which is a fairly big number, which has not been attained elsewhere. But that was something which the government plans to do that. And there was a cabinet meeting just before the budget, and they identified some of the public sector undertakings and which could be either put on the strategic sale or on the there can be an IPO or total sale, privatization. So all these are important aspects which the government brought in this budget. But to balance the budget, the government relied on large borrowings, increasing by 16% over the last year. This is no doubt likely to add pressure on the borrowing cost and can raise concerns over inflation. That is what, through the economic survey, the government tried to argue and voted in favor of growth and wanted better sovereign rating so that the businesses can raise credit abroad at reasonable rate and do not get hurt. To soothe the freight concerns, it said that it has plans for a calibrated deficit reduction, reducing from 9.5%, which is going to be in the current year, 2021, to 4.5% by 2025 over the next 5 years. Answer to that, to achieving that, the government felt is through growth. I feel that these words, let me hand over to Ashutosh.
Yes, thank you, Sanjay. So I will be speaking about the corporate tax proposals in the budget. And, just taking off from where Sanjay left, the revenue projections, the tax projections for the coming fiscal are definitely doable and look very reasonable. And I think that has a down the line impact in terms of, the behavior of tax authorities, because I think they will be under much less pressure to, meet revenue targets. So that is anyway, this budget is a good, precursor for that in the terms of the of the reasonable target setting which has been done, which is quite a departure from earlier years. On the corporate tax front, the first thing I would say is that there is no major highlight, which is very good. There is no change in the corporate tax rates. Certain tax incentive dates have been extended essentially to 31st March 2022 for affordable housing projects. The approvals can now be had by 31st March 2022 for eligibility for the tax rebate there. And similarly, the tax holiday has been expanded to include rental housing projects also besides affordable housing projects. And these projects also, if approved by 31st March 2022, would be eligible for the tax holiday. As far as startups go, again, there already tax holidays are there for the startups. Those dates by which they could qualify for those to be eligible for the deductions have also been extended up to 31st March 2022. In terms of expenditure disallowance, that has been tightened. So in case of a company, the employee welfare funds like provident funds and superannuation funds, currently the company is supposed to deduct the employee share and deposit it into the government account. And in case that those deductions have not been deposited by the due dates in those statutes, now that expenditure will be disallowed under the Income Tax Act. So that is something which I think businesses and who people on this call need to have a look, because this actually will be implemented from the current financial year itself, which is financial year 2021 itself. These statutory deposit due dates need to be scrupulously followed. Could we go to the next slide, please? This whole slide, I'd like to talk about, certain international taxation, provisions with regard to and the corporate tax implications and the tax implications with regard to them. So the first thing, again, I think of major interest for foreign businesses is the equalization levy. And this equalization levy is what is being called as the digital services tax in other jurisdictions like the United Kingdom, in France, and other such jurisdictions. And we know that that the United States Trade Representative's Office has taken up all these taxes as and investigating them as being discriminatory against US companies. But setting that aside, the equalization levy itself, in this budget, the scope of that equalization levy has been specifically expanded through clarifications. So therefore, the levy is on online sale of goods and provision of services, online provision of services. But the clarifications have now been made to include any acceptance of offer for sale, which is online, any placement or acceptance of a purchase order, which is made online, and similarly a payment of consideration and part supply of goods and provision of services. So all of these get included in the ambit of what is online, and that scope gets expanded. Similarly, the consideration on which this levy is to be imposed, that has also been clarified to say that the receipt for sale of goods or provision of services, if for the e-commerce operator who's located abroad, that entire consideration itself would be subject matter for the levy. And another clarification is that if the receipt from royalty or fees for technical services, if they're already taxable in India, those receipts would not be subjected to equalization levy. This again, is clarification is more for the revenues benefit, because the tax rate on the FTS and royalty is higher than the equalization levy rate. And crucial thing which I wanted to underline is that all these amendments are issued as clarifications. So even for the current financial year, which is ongoing, financial year 2021, these clarifications would apply. Therefore, it's good for businesses to go back to the drawing board, have a look at their own intergroup transactions, which they may have studied with regard to equalization levy, and have a relook before the end of the financial year. The other is on sovereign wealth funds and pension funds. In the last budget, there was a tax exemption which was announced for these sovereign funds and pension funds, and that essentially was in case of their investments made in infrastructure, which Sanjay and Hannah were talking about earlier, the great boost to trying to get funding for infrastructure through various sources. This is one of the ways in which you are trying to channel capital from abroad, and guaranteeing that the income which you'll get from infrastructure funding in India, that would be exempt. So these provisions have been specifically relaxed in terms of what are the types of sovereign wealth fund which will get it, what is the kind of activities for which they will get the this particular exemption. There were a number of questions about these. So those have been specifically clarified, and they have been clarified in favor of, in favor of relaxations. That's a welcome move. Similarly, on foreign portfolio investors, Sanjay briefly mentioned this. Foreign portfolio investors themselves, there was a slight hitch in the sense that they were being subjected to withholding on dividends, and that there was a specific rate under the Income Tax Act. And because of that, they were not able to access the beneficial treaty rates at the time of withholding of the tax. So the statute is being amended to specifically say that FPIs or a non-resident would be able to access a beneficial treaty rate at the time of withholding itself. Hannah spoke about the Gift City, which is essentially the International Financial Services Center. And yes, there has been a substantial expansion of the incentives. Essentially, the IFSC is a case where where all of these units, they are being given tax exemptions in order to attract investments in the IFSC. And one of the major relaxations or expansion of incentives has been to investment divisions of overseas banking units. So a number of income streams of these investment divisions are being exempted under if they are located in IFSCs. Similarly, an investment fund or investment fund manager which is located in an IFSC, the provisions have been relaxed so that their global income does not get taxed. And also further new activities like transactions relating to lease or sale of aircraft or aircraft engines, those particular activities have also been allowed tax exemptions for units located in IFSCs. So there are a number of other smaller, things which have been ironed out, which one can go to the finance bill and look at those specific things depending on one's interest. Could we go to the next slide, please? Again, on reorganization and new compliance obligations. So this is more for domestic companies. So the goodwill has been specifically clarified that this will not be an intangible asset, and therefore it will not be eligible for a tax depreciation. And again, this is from the current year itself. Also, it's been there were certain provisions with regard to slump sale, and it's now been specifically stated that the slump sale extends to any kind of a transfer, not just a sale. Also, a new obligation, a TDS obligation has been cast on companies. So companies with a turnover in excess of INR 100 million, they will now have to deduct tax at source at 0.1% if they purchase goods exceeding 5 million from a resident. So that's a single seller, and this will apply from the 1st of July 21 to transactions after that date. Also, the TDS and TCS rates have been increased. So the deduction rates have increased in case the person to whom these apply or those payments are being made is a non-filer. And again, this is from 1st July 2021. This last one, these last two are essentially additional compliances for companies. So they will have to gear themselves up for these provisions. And one would hope that during the course of the next couple of months, government will be able to allow companies to smoothen out the compliance on this. Because, for example, how does a company get to know that the person to whom it's paying is a non-filer? So we believe that there would be some enablement or some done through the income tax portal, whereby deductors would be able to get this kind of information. But let's see, how this compliance is implemented. For the slide here, essentially, let me step back and say that the reason I think that the number of amendments or major amendments on corporates and compliance, which are now coming in the budget, actually are a precursor of what happened during this COVID year, where the government introduced faceless assessment scheme and appeal schemes have been announced during the course of that entire year. And now essentially because all of income tax processing, return filing, return processing, assessment, all of these are essentially through the income tax portal and will have very little interface, physical interface with the income tax department. This has resulted in the government now announcing that for assessment year 21-22 returns, so that is essentially all returns of the current financial year, when they do get filed, all the timelines will get scrunched. So essentially, a corporate return could be filed by 31st October 2021. If it's a transfer pricing return, 30th November 21, and I'm talking about an assessment year 2021, 21-22 return. And there in that particular case, a scrutiny notice itself will have to be issued by the department within 3 months of the end of the financial year, so by the 30th of June. And the assessment completion deadlines have also been reduced. So it's now 9 months from the end of the assessment year. So if we look at this, we are essentially now reducing the entire timeline from the filing of return to the completion of assessment substantially. And that I think is coming out of the technology initiatives which the government has made over the past couple of years. Also, the reopening of assessments, those timelines have also been reduced, and the procedure has also been substantially revamped. Could we get to the next slide, please? And the last slide is on the dispute resolution authorities and the revamp with regard to that. So again, as I said, the faceless assessment proceedings, they are now being introduced for appeals also before the Income Tax Appellate Tribunal. The government has announced that there will be a scheme which will be coming through. The authority for advanced rulings is going to be replaced by a board for advanced rulings. That is more like an internal board, because it will have officers of the department. Of course, then those particular orders will be appealable by either party to the High Court. The Settlement Commission has been discontinued from 1st February 2021, and any pendencies in the Settlement Commission will be looked after by an interim board. And their dispute resolution committee format has also been announced, but that is for small taxpayers, so taxpayers whose incomes are below 5 million. And the variation in whose case of the assessment is up to 1 million. So these are again major initiatives on reducing disputes and resolving them quickly.
So let me move to Saloni. Saloni, would you take over from here?
Yeah, thanks, Sanjay. Coming to the indirect tax proposals, there was relief. There was an expectation in a sense that there would be a COVID cess surcharge, but luckily, the finance minister stayed away from additional COVID-related surcharges and cess. Broadly, the principles that were announced on GST, she spoke about record high collections in GST, attributing it essentially to the use of artificial intelligence and analytics, data analytics by the GSTN, and that's helped in identifying cases where there were risks, and the government has approached such taxpayers, and that has contributed to the peak rates of GST collections. The other message that came through was that the government is keen to continue with the Make in India initiative and vision, and some of the changes that were announced were in line to that vision, specifically in relation to customs, in terms of increasing duties on finished products, and even increasing duties on certain raw materials if they could be sourced internally. But essentially reducing, the general trend is to reduce raw materials and become going up higher in the value chain. So the other aspect that was spoken of also was regarding customs exemptions. Can we just go back to the previous slide, please? Yeah. So also, so that India is in the in the global supply chain. Essentially, the government's aim is that India goes up in the value addition chain. We can move to the next slide. The budget now is essentially, from an indirect tax perspective, focusing essentially on customs. But we saw this year and also in the previous year, there were changes announced in GST as well. GST changes are now typically announced by the GST Council, and there were few changes that were announced here. I realize that I'm running a little late, so I'll just pick on some of the key topics and key changes. There's a GST audit certificate that has been dispensed with, and this will now be replaced by self-certification by the taxpayer. Input tax credit now will only be available on invoices that have been uploaded, the details of which have been uploaded on the GSTN network, and that are so there's a delay, then the credit cannot be availed by the recipient. Vendors would need to be diligent about entering details of supplies. There are certain changes which have been introduced regarding zero-rated supplies. So this is a proposal regarding supplies to SEZs. Currently under GST, all supplies to SEZs are exempted, but there is a proposal to change it to restrict it to only authorized operations of SEZs. This is taking it back to the service tax era. Then the rebate of GST paid on exports will be restricted to only notified categories. Refund of export of goods will be linked going forward also to receipts in foreign currency. Currently, the refunds for export of goods were linked to a shipping bill. As long as there was a shipping bill, that was sufficient. But now an additional requirement would be that payments are also recovered in foreign currency within the time period prescribed under FEMA. Next slide, please. Coming to the customs changes, customs is going to see a complete revamp, and we'll have a new structure in place in October of this year. Separately, what has been announced is there will be a common customs electronic portal, and this portal will be used for filing bills of entry, shipping bills, duty payments. Notices will also be communicated through this portal, so one would need to be vigilant and regularly check the portal to see if there are any communications by the department. All existing customs exemption notifications, the validity has been limited to 2 years, and going forward as well, a validity of a notification will only extend up to 2 years. So this is a huge departure from the past, where and in a sense notifications, we need to keep a watch whether they will be extended beyond a particular period or not. So this brings in some kind of uncertainties. Investigations are to be completed within 2 years from the date of initiation. This is definitely a positive measure. Let's move to the next slide. There's a new levy which is called the Agriculture Infrastructure and Development Cess. This levy is going to be imposed as part of customs duty, but it is not going to be in addition and creating an extra burden on consumers. The basic customs duty of products has been reduced wherever this agriculture infrastructure cess has been introduced, so that the net effect is not enhanced. We can move on to the next slide. So customs duties have been reduced on certain specified iron and steel products. Gold and silver, it has been reduced. Import of parts and components by PSUs under the Ministry of Defense have been, if imported for manufacture, have also been exempted from duty. High-speed rail projects have also been brought under the project import scheme and will be eligible for a 5% concessional duty. Then there are other concessions extended to auto parts, mobile phone parts. The basic customs duty has been enhanced, essentially so as to encourage manufacture locally. We can move to the next slide. Here we have some few rate changes. I think we can quickly just glance through these, and I'd ask Alok to take over after this. Can we just go to the next slides? Yeah, I think we can move to the next. Yeah, Alok, I'd request if you can take the section on personal taxes.
Thanks, Saloni. Just to reiterate the point discussed earlier, that there was no surprise element in terms of an additional COVID cess or a new surcharge for higher income individuals. So that was a big relief. These rates and slabs remain the same as were introduced last year. And perhaps because there has been a significant change by way of the concessional tax regime, which was introduced last year, that was another reason for not tinkering with the tax rate this year. So we can move on. As far as the leave travel concession benefit that was introduced by the government a few months ago, that was introduced by way of notifications, and this budget proposal is to just include it in the law because the exemption has to be covered by the relevant provisions of the Income Tax Act. There was an expectation that this may be extended to the next year, but there has been no such extension. Perhaps with the travel opening up and the vaccine situation looking positive, and in general, there have been not many new incentives. The government has left this benefit only for the current year, which is ending March 2021. This is a specific provision that kind of reduces the attractiveness of ULIPs from an income tax perspective, because many individuals were using this as an additional investment avenue, which was tax efficient, because the maturity proceeds from ULIPs were not taxable under Section 10 of the Act, which covers insurance policy payouts as well. And the provision introduced here is that if the premium payable on such a ULIP policy, whether a single policy or in the aggregate, exceeds 250,000 rupees per annum, then that will not be exempt from tax, and that ULIP will be treated as a capital asset. So the idea is to, give it some benefit and not treat it as complete income, because that would be pretty harsh, I would say. So it is kind of a balanced approach where they have denied the exemption, but are allowing you to treat it as a capital asset and as an equity oriented capital asset. So it will be taxed at 10% without indexation. Moving on. I'll just cover the second one in the interest of time. So we had many returning Indians who were facing a challenge where, let's say, if they were working in the US for many years, contributing to the US 401k scheme, and they were going to get taxed as per US law only when they would withdraw that amount, and they could choose to withdraw that amount, let's say in their 60s. But they may have returned to India, let's say in their 50s, and they have become ordinarily resident for Indian tax purposes. So there was a risk that the income that is accruing in that 401k fund was taxable, and there was some litigation around this. So this relief is sought to be provided to align the mismatch between the overseas taxation and the Indian taxation, because in the example I was describing, you could have a situation where India would seek to tax it at an earlier stage and the individual would pay US taxes a few years later on the entire withdrawal. So we will have to wait and watch on how this relief is provided. Perhaps they may allow some sort of a carry back of the foreign tax credit, or they may push the timing of taxation of such retirement funds to align it with the timing as per the overseas country. As far as senior citizens are concerned, it's a limited relief because number one, they have created this category of senior citizens above 75 and not used the current senior citizen definition of above 60. And it is only where these individuals are getting pension and bank interest from the same bank. So I would say it is some relief, but not very significant. Moving on. The first one in terms of extension of the deduction for mortgage interest on affordable housing. This was expected to be extended and they have extended it by 1 more year. So this is the additional deduction of 1.5 lakhs over and above the deduction of 2 lakhs that is available under Section 24. So Section 24 deduction does not restrict to depending on the value of the house, but this additional deduction of 1.5 lakhs under Section 80 EEA was introduced only with respect to affordable housing where the stamp duty value does not exceed 45 lakh rupees, that is 4.5 million rupees. And now, even if the loan is sanctioned by, or rather after 31st March 2021, anytime up to 31st March 2022, the individuals will be able to claim the additional deduction. So this was expected. The next one is the big surprise where all individuals who have employee PF contributions in excess of 250,000 rupees per annum will need to pay tax on the interest accruing on that excess contribution. There is some ambiguity because of the because of the drafting in terms of whether this is sought to be taxable on a yearly basis or only at the time of withdrawal of the PF balance. And we will see once the rules are prescribed, because the section indicates that there will be a rule prescribed for the basis of taxation. Based on the way it is drafted, the intention seems to be to tax it on withdrawal, but the language does create a risk for taxation on an annual basis. So especially for those individuals who follow an accrual basis of taxation for their income from other sources, this is a concern and we are hoping that this is clarified soon. While this is not really income tax related, this is a significant development that we are expecting from April 2021 in terms of the 4 labor codes which are already part of law to enter into force. So the FM acknowledged that these labor codes are on the anvil, and some of the significant changes brought about by these labor codes have been summarized on this slide. So again, this is something which we will know in the next few weeks in terms of the government's intention to implement this from April 2021. It may have an impact on some of the areas like Provident Fund, etc. And there may be an interplay with income tax provisions as well.
For Mr. Sanjay Kumar, what is the key driver for IMF's optimism on India GDP growth in 2021? Expected to be highest growing economy of the G20 with 11.5%. This has been asked from Mr. Alex of Virgin Atlantic.
Oh, thanks, Saloni. So I thought that IMF, while coming out with this growth numbers, talked about the activity and mobility, how quickly it came back to India faster than expected. And also that India did take certain decisive action to deal with the pandemic. And today we are having the countrywide about 150,000 or lower than that number in the get people affected by that. And also the death rates were far less than any other place. So basically, it's about the mobility. And let me also say that while the IMF did that 11.5, Government of India did something close to that. And even our independent verification on an economic model suggested the same number. So it is not that these numbers have just come about, because we also employed our own model, and the mobility and activity that India bounced back with certainly was the reason for such high growth numbers. And of course, the low base.
Yeah, thank you. So second question again is for you, Mr. Sanjay. Given that it is 8 months or so since India was in full lockdown, why has its GDP performance been so sluggish while other countries have healthier economic numbers during periods of strict lockdown?
One thing that I could say that it was the entire thing was very dramatic. The Prime Minister closed down shut down the entire nation with one pronouncement, and thereafter the mobility and all kind of activity just stopped. So, and then they were very careful in opening each of these sectors. So much so that the entertainment and hospitality sector opened only on the last Monday. So there have been difficulties, and there were certain problems also, not to say that there was nothing, but the fact that India went for a very careful way to address the whole thing was the reason that India could bounce back. And not to say that it is the lockdown was only for about 8 months, it was far longer. In fact, if you look at each of the sectors, the hospitality sector got opened only on the 1st of February or so. So to that extent, there has been a lockdown, and still we have to be very careful about the whole thing. Other point that I would mention is that while many countries had a second wave, India did not have the second wave. It had just one peak, and thereafter it went down. The only problem is that we are staying at the same number of 150,000 or thereabout over the last 7-8 days, and that is something we would want that to also go down.
Thank you, Mr. Sanjay. So the third question is for Mr. Ashutosh with regards to corporate tax. You mentioned that a company whose turnover is in excess of INR 100 million has to be deducted TDS on purchase of goods in excess of INR 5 million from a single seller. For which period does the company have to check the INR 100 million threshold?
Yes, thanks, Saloni. So the company will have to look at its turnover in the previous year. So if you are in year 1, then you have to check that in year 0, the previous year, if your turnover exceeded that particular threshold, then in this current year you will have to do the TDS on those particular purchases.
Okay, thank you so much, Ashutosh, Mr. Ashutosh. So the next question is for Ms. Saloni Roy for indirect tax. How do you see the conditions for claiming input tax credit in GST?
Yes, so the government actually has been closing in a lot on input tax credit claims, and they have been, trying to avoid fraudulent claims of input tax credit because they feel that there's a lot which gets lost there in terms of revenue. So in fact, the changes that were introduced last year and then again this year, gradually they've been all towards tightening the credit chain. And this year they've restricted it only with respect to invoices that are uploaded on the GST portal that you can take credit. So that's the limit. So previously it was for all invoices, and gradually it has been from 20% and 5%, and now it's only limited to those invoices which are uploaded on the portal. Though this can be questioned as to if it's a vendor's error to not upload, then how can the taxpayer be penalized for that?
Thank you so much. So I have one more question. How has the level of unemployment changed during the pandemic? Does the budget provide additional support for those who have been made redundant recently? Any one of you would like to answer that?
Let me answer that, Saloni Madan. So, unemployment definitely came about, and government has brought a kind of measure for the migrant workers, because that was the one area which required a direct attention. And in the in the budget which has just been announced, the government did bring about something. And then the government is also thinking of how to address and provide certain social security to these migrant workers. And of course, with the growth and manufacturing picking up, and even the services sector picking up, I think the unemployment numbers are going to go down, and there will be far more jobs for everyone. Construction, entertainments and hospitality sector, travel sector, all those things are up for grab for by these people. Even the manufacturing.
Okay. Thank you. Thank you so much. So quickly, just one last question for individual tax. When will the interest occurred on EEs and PF contribution above 2.5 lakhs per annum be taxable on yearly basis, or that at the time of withdrawal? Mr.
So
Alok.
we have, yes, we have to wait until the clarification is issued because the provision talks about a rule to be prescribed for calculating the tax, and we will know at that point whether the intention is to tax on a yearly basis or on withdrawal. It will be a bit complex for the government if they are intending to tax this on a yearly basis. So we hope that the clarification indicates that it will be taxable only at the time of final withdrawal.
Thank you, Alok. Thank you. I think we have enough. So I will now like to invite Ms. Delia Hennigan to give a vote of thanks. Delia, over to you, please.
Okay, thank you. Thank you, Saloni. I hope everyone can hear me. I would just first of all like to say how interesting that was, and I think that you could tell how important it was to everyone by the number of questions that were being typed into the chat box as we went through. I would like, on behalf of the BBG committee, to say thank you very much to the British High Commission, first of all, to Hannah Mayer for her kind introduction, but especially to our colleagues from Deloitte, who is a very valued member of the British Business Group, and to the partners who today have given up their time and also shared their expertise and insight at this key point in the business calendar in India. So thank you so much, all of you. It's much appreciated, and I know has been extremely helpful and interesting to the audience today listening to this. So thank you so much from the BBG. And the other thing I would like to do is, first of all, is secondly, thank our audience for joining us, and to remind you that this is a fixed spot in the BBG calendar for the budget overview. But of course, there are also many other opportunities to join us to get insights and expertise in topics and issues of interest to doing business in India. So do join us at our events